Most small businesses struggle with things like finance and understanding what it takes to run a business from a financial aspect. We're covering that in today's ramble. That's a thing I really struggled with back in my early parts of my career. I was really a solid technician, but I was really not that great on the business side of the world. And so hopefully this will help you level up your financial acumen as we get going. Starting off at the top, we're going to talk about revenue. Now, revenue is also known as income by some. It's okay to interchange them a little bit. It's nice to be consistent, so I'm going to call it revenue, but if anyone calls it income, that is also just fine. Revenue is simply the dollars that you make from the goods or services that you sell. It's as simple and straightforward as that. One of the benefits of paying attention to this financial stuff is that you can start separating that revenue into different discrete lines of business that you work in. In my world on the MSP side, we break our revenue into things like the hardware and software that you sell as like one-time product stuff, and then things like cloud stuff, right? The recurring product things like the Microsoft licenses and those types of things. And then you have your services, right? The services becomes a big portion of it as well. And so when you break your revenue into different lines of business, you end up making it easier for you to understand what's going on. Now, if I were to put myself into, let's say I was running a laundromat or a laundry service, I might have revenue from coin-operated machines. I might have revenue from laundry that's been dropped off. I just need to launder some shirts, and maybe I've got some dry cleaning, right? Those are the three discrete buckets of revenue that you might think about if you're in a different service. Now, I'm going to be talking about all things service business related. I live in the service business area, and so I know the most about those kinds of things. So if you are a car dealer or something like that, this might not be exactly applicable to you, but it's probably pretty close. So the second thing I want to talk about here is costs of goods sold, or known as COGS. Costs of goods sold are the direct costs related to generating the revenue in your business, right? So if you sell a laptop, again, using the MSP side of the world as an example, if you sell a laptop, you had to buy it from somebody, right? When you bought it from your distributor, that's a cost of goods sold. Same thing on the license side of the world, right? If you sell a software license or like a cloud license, Microsoft 365 as an example, you bought a license from someplace and then you sold it to somebody, right? That purchasing of the license is your cost of goods sold as it relates to that. It also includes things like labor for your services, right? So your technicians, your service manager, your triage and dispatch person, those types of people are also costs of goods sold because that's labor directly related to generating the revenue, right? And the reason why we break these apart like this, and we talk about it this way, is because it helps us get better data further on down the P&L when we talk about things like gross margin and gross profit. We'll get there in a minute. When we think about the laundromat example, that would include things like all the supplies and soap and all of that kind of stuff. It would include all your hangers and the plastic bags that go over the shirts that you launder, and it would cover things like maintenance on your equipment, and it would also cover things like the people who are doing the laundering of the garments, right? It's those folks that are the direct costs to generate that revenue, right? Again, it's all about the direct costs. Let's talk about the next set of terms. We're talking about gross profit and gross margin. To get to gross profit, you take your revenue and you subtract your COGS. That gets you your gross profit in dollars. Now you take those gross profit in dollars and you divide it back by the revenue and multiply by 100, and that gets your gross margin as a percentage. Now, I covered gross margin before in a different video. I'll link it up above as well. But the idea here is that you want to understand the gross profit dollars and the gross margin percent, because it's entirely possible to make more gross profit dollars but make them at a less efficient rate. The way I like to look at it is if gross profit goes up and gross margin goes up, you are being more efficient, right? You're generating more money more efficiently. Now, if your gross profit goes up and your gross margin stays the same, you're being as efficient as you were before, probably just fine. Now, if your gross profit goes up and your gross margin goes down, that means you're working harder to generate that extra income. And all of those situations might be fine. It's important for you as a business owner to understand why things are happening the way they are and to take action if needed, right? That's the piece here. Lastly, as it relates to gross margin and gross profit, this is where the concept of the line comes in. Anything above the line are things I've already covered, right? It's all the revenue and COGS and those kinds of things. The line happens to be gross profit, and anything below the line is coming up next. So let's head below the line now. Below the line is really a couple different terms, right? The first term that we want to talk about are expenses, or SG&A expenses, which stands for selling, general, and administrative expenses. It's basically kind of all of the other things that you spend money on to support your business, right? That's what SG&A typically stands for. And that includes things like rent. That includes things like your insurance. It also includes things like the salaries for your financial folks, the salaries for your admin folks, the salaries for your executives, also all of your sales and marketing expenses, right? Again, this is for service-based businesses, but most businesses follow this line as well, is is that sales and marketing expenses are also below the line. The idea here is you use all of these expenses to help move the business forward, but they don't directly relate to the revenue generation activities that you do within your business. Last couple terms to cover before we wrap this up. The last two terms are EBITDA and net income. EBITDA is a fancy acronym that stands for earnings before interest, taxes, depreciation, and amortization. Basically, it's a fancy acronym that says it's all of the things before your accountant really gets super involved in things, right? It allows you to compare yourself against yourself over time a lot easier than it would be if you're taking into account taxes and those kinds of things, but it also allows you to compare yourself against others in the industry, especially if you have some level of benchmarking that your industry provides, right? There's a number of people that benchmark in the managed services space that I live in, and it can be really helpful to benchmark and understand kind of how you're doing versus the industry at large. To calculate EBITDA, you basically take your gross profit, subtract out your expenses, and don't include the interest, taxes, depreciation, and amortization expenses, and that gets you EBITDA dollars. You can then take those EBITDA dollars and divide them back by revenue again and multiply by 100, and that gets you your EBITDA as a percentage, right? And all of the same rules that applied for gross margin apply for EBITDA as a percentage, because you can make more raw dollars in EBITDA and make them much less efficiently. So if your EBITDA dollars goes up and your EBITDA percent goes up, that means you made more money more efficiently. If your EBITDA dollars goes up and your EBITDA percent stays the same, you had essentially the same level of efficiency. And if your EBITDA dollars goes up and your EBITDA percent goes down, that means you worked harder to generate that EBITDA. Now, all of those things might be perfectly fine in your world. Those are things that you need to decide as a business owner. But the idea here is that you want to be paying attention to EBITDA dollars and percentages. Net income is that kind of true bottom line figure that basically means that you take out that interest, taxes, depreciation, and amortization, right? That's basically, it's revenue, subtract out your COGS, subtract out all of your other expenses, and that gets you your net income. And that gets you the opportunity to see what's going on kind of fully. But again, we like using EBITDA for comparison purposes because it eliminates some of the variables that are harder to control for. Now, with all of this, you aren't expected to be a financial wizard right away, right? This is a thing that you're going to have to spend some time on, some time learning about, and those kinds of things. And so I want you to be aware that it's okay to have some learning to do, because we covered a lot of stuff today, right? We covered revenue, we covered COGS, we covered gross profit, we covered gross margin, we covered expenses or SG&A, we covered EBITDA, and we covered net profit. That's 7 different terms that maybe you didn't have a whole lot of experience with before, right? There's a lot to learn, and it's okay to incrementally learn things as you go. All those terms also land on your P&L, which also stands for profit and loss statement. I'll link above as well for that, because I recorded a video on that earlier as well. So with all of that said, I would love it if you click the like and subscribe. It helps me out on the YouTube side of the world, and I really thank you for coming on this ramble with me. I hope to see you on the next one.